History has shown one thing over and over again. No dominant currency stays on top forever. The Dutch guilder once held that position. Later, the British pound took over. Today, many are wondering whether the US dollar could be heading down the same path. Financial markets have already started raising questions. Analysts have pointed to a growing trend of investors reducing their exposure to American assets. The US dollar has also weakened against major currencies, at times reaching levels not seen in years against the euro. As confidence slowly fades, a bigger question emerges. Is the world beginning to move away from the dollar as its preferred global currency? If that were to happen, the consequences would be enormous. Even Donald Trump has warned about the importance of maintaining the reserve currency status. In his view, losing that position would be comparable to falling from the ranks of the world's leading economies. But how accurate is that claim? After all, both the Netherlands and Britain eventually lost their status as issuers of the world's primary reserve currency, yet neither country collapsed into poverty. In fact, both remain wealthy and influential nations today. There is another important reason to be cautious before predicting the end of the dollar. We've seen similar fears before. During 1970s, many economists were convinced that the dollar's dominance was nearing its end. Some expected gold to replace it. Others believed a basket of international currencies would take its place. Instead, the dollar recovered and emerged even stronger than before. Could history repeat itself once again? And if the dollar were eventually to lose its privileged position, what would that actually mean for the United States and the rest of the world? To understand the answer, looking only at today's headlines isn't enough. We need to take a much longer view. That means traveling back roughly 4 centuries and examining how reserve currencies rise, thrive, decline, and sometimes make unexpected comebacks. We will begin with the story of the Dutch guilder. The year is 1609. The Dutch Republic is rapidly transforming into one of the most powerful trading nations on earth. At the center of this commercial empire stands Amsterdam. Unlike many other parts of Europe, Amsterdam offered something incredibly valuable: strong legal protections for wealth. Even nations that were actively fighting against the Dutch could safely store money there. As a result, silver coins from across Europe poured into the city. Much of that silver ended up in an institution that would later inspire modern central banking, the Bank of Amsterdam. Officially, every deposit was supposed to be fully backed by silver held inside the bank's vaults. However, history would reveal a different reality. The bank quietly used part of those reserves to provide extremely cheap financing. Two major beneficiaries stood out. The first was the Dutch East India Company, the most powerful corporation of its era. The second was the city government of Amsterdam itself. In effect, Dutch institutions gained access to financial advantages unavailable to most of their competitors. Centuries later, French policymakers would describe a similar benefit with a phrase: exorbitant privilege. Being home to the world's reserve currency gave the Dutch Republic several major advantages over much larger rivals such as England and France. The first advantage was lower borrowing costs. Dutch provinces could often borrow money at interest rates of only 2% to 3%. Britain typically paid around 5% to 6%. France, viewed as less reliable borrowers, sometimes faced rates as high as 10% to 12%. The second advantage was access to larger amounts of capital. Investors were willing to lend far more money to the Dutch than they otherwise would have. This allowed a relatively small nation to finance an enormous navy and dominant international trade routes. The third advantage appeared during times of crisis. When uncertainty spread across Europe, capital frequently flowed into Amsterdam rather than fleeing from it. While many governments struggled to raise money during emergencies, the Dutch often found borrowing becoming easier. This proved especially important during the famous year of disaster. During that period, the Dutch Republic was attacked simultaneously by France, England, and several German states. This situation looked dire. Enemy forces advanced rapidly, and the survival of the Republic seemed uncertain. Yet, despite the danger, Dutch authorities continued to secure financing at relatively favorable rates. That access to capital allowed them to recruit foreign mercenaries and support allies willing to join the conflict on their side. At the same time, England faced severe financial difficulties. King Charles II became so short of funds that he was forced into a partial default on government obligations. The result was a major financial shock in London. In many ways, reserve currency status helped save the Dutch Republic during one of the most dangerous moments in its history. But every advantage comes with a potential downside. The same financial privileges that fueled Dutch success eventually created new vulnerabilities. We could think of this as a hidden cost of exorbitant privilege. Access to easy money encouraged excessive borrowing. Provincial governments accumulated more debt. The Dutch East India Company also became increasingly dependent on cheap financing. Abundant liquidity helped drive speculation, particularly in real estate markets. Meanwhile, the Bank of Amsterdam expanded lending even further, especially to the already overstretched East India Company. Another problem began to emerge. A growing share of financial gains flowed toward a small and increasingly wealthy elite. As wealth concentrated at the top, inequality across Dutch society widened significantly. Economists argued that the very advantage that once empowered the Dutch Republic eventually became a weakness. Their argument is that easy access to global capital pushed the Dutch economy towards finance while gradually reducing the importance of trade, manufacturing, and craftsmanship, the sector that had originally driven Dutch success. Over time, Dutch investors became increasingly focused on earning returns from foreign assets rather than building productive industries at home. Ironically, many members of the Dutch financial elite grew wealth by financing the development of countries that would eventually surpass the Netherlands. Among the biggest beneficiaries were France, the United States, and especially Britain. Dutch capital flowed into Britain's growing economy and even into Britain's American colony, but these investments would eventually contribute to geopolitical tensions. The Fourth Anglo-Dutch War proved disastrous for the Dutch economy. Trade collapsed, financial confidence weakened, and the once mighty Dutch East India Company ultimately went bankrupt. The consequences extended far beyond a single corporation. Confidence in the Bank of Amsterdam began to deteriorate as well. For the first time, people questioned whether the institution truly possessed the reserves it claimed to hold. As trust faded, the value of the bank's money began to diverge from the silver it was supposedly backed by. Even so, the Dutch financial system did not collapse immediately. One reason was that Dutch investors had spread their wealth across multiple countries. A significant portion of their asset was invested in loans to the French monarchy, but this diversification soon backfired. The French Revolution swept away the old regime and severely disrupted those investments. The resulting losses further weakened the Dutch Republic. By the time French Revolution armies arrived in 1795, the Dutch state was too fragile to resist effectively. French leaders saw Dutch wealth as a valuable resource for funding their military campaigns. Yet the greatest long-term beneficiary was arguably not France but Britain. Once Amsterdam lost its position as Europe's premier financial center, capital increasingly flowed to the London instead. London effectively inherited the role that Amsterdam had once played. Even after the Dutch eventually regained their independence, the situation had fundamentally changed. Their debt burden was enormous. Britain's financial system had become dominant, and the Netherlands never recovered its former reserve currency privileges. For decades, the Dutch focused largely on servicing accumulated debt. Economic growth remained sluggish for much of the following century. Investors who once treated Dutch assets as a safety in Europe now preferred British markets. Borrowing costs shifted accordingly. The Dutch often found themselves paying higher rates than Britain. During international crises, money no longer rushed toward Amsterdam. Instead, it followed into the expanding British Empire. Before moving on to Britain's story, it's worth comparing the Dutch experience with the United States today. Many economists argue that America currently enjoys a similar form of reserve currency privilege, despite carrying one of the largest debt loads in the world and running substantial budget deficit. The US government can still borrow at relatively low real interest rates. That ability provides an enormous advantage. During major crises, investors frequently seek safety in American financial markets. The 2008 financial crisis demonstrated this clearly. Even though the crisis originated in the United States, global capital still poured into dollar-dominated assets. Just as investors once flocked to Amsterdam, modern investors often rush toward New York. However, critics argue that America may also be experiencing some of the same side effects that appeared in the Dutch Republic. Concerns include growing government interventions, rising asset bubbles, and widening wealth inequality. There are also parallels in the international system. Dutch capital helped accelerate the rise of Britain and France. Likewise, many analysts argue that China's economic ascent was made possibly in part by the global dollar-based financial system. Near the end of Dutch dominance, a series of shocks exposed weaknesses that had previously gone unnoticed. One of the clearest warning signs appeared when investors no longer treat Dutch assets as the ultimate safe haven during crises. During war and political turmoil, money stopped flowing into the Dutch Republic. Instead, it began moving elsewhere. Some observers see echoes of this pattern today. Following recent market turmoil and policy uncertainty, investors at times pulled money out of the United States rather than into it. For those drawing comparisons to the Dutch history, that shift is particularly significant. In the Dutch case, losing safe haven status marked the beginning of a much larger decline. Only a few years later, Amsterdam fell under foreign control. Yet, there are also major differences between the Dutch Republic and modern America. The most obvious difference is military and geopolitical scale. The United States faces no realistic threat of invasion from a foreign power. An even more important distinction involves the nature of money itself. The Dutch guilder was ultimately tied to precious metals. The dollar operates under a completely different system. Another critical difference is the absence of a clear successor. When the Dutch dominance faded, Britain was waiting in the wings. Britain possessed a larger economy, growing military power, and a rapidly developing financial system. Dutch bankers even played a role in helping establish institutions such as the Bank of England. The transition from Amsterdam to London therefore had a clear destination. Today's world looks much less straightforward. No single country appears ready to replace the United States in the same way Britain replaced the Dutch Republic. Because of that, the future of the dollar may follow a very different path. To understand what the path could look like, we need to examine a much closer historical comparisons that bring us to the rise of British pound. The year is 1799. Napoleon Bonaparte has recently taken power were in France. Europe is now dominated by a struggle between two emerging giants. France commands the strongest land army on the continent and continues expanding its territory. Britain, meanwhile, controls the world's most powerful navy and dominant global commerce. By occupying the wealthy Dutch Republic, France helped Britain inherit one of history's greatest financial advantages. A reserve currency status was gradually shifting toward London. The benefits were immediate. Britain could borrow at interest rates near 3%. France often faced borrowing costs of 10% or even higher. Britain used this financial edge strategically. Rather than fighting every battle alone, it financed coalitions across Europe. Subsidies flowed to Austria, Prussia, Russia, and other powers willing to oppose Napoleon. At the same time, Britain's navy imposed a vast blockade on France and its allies. Maintaining this effort required extraordinary government spending. Public debt eventually approached level close to 200% of the GDP. Such borrowing was unprecedented. The pressure became so intense that investors began demanding precious metals in exchange for their banknotes. To prevent a financial collapse, the Bank of England suspended convertibility into gold and silver. In practice, this meant the pound temporarily became a fiat currency. Many expected the currency to lose its value immediately, yet that never happened. Why? Because a currency's strength depends on more than precious metal. The pound was ultimately backed by the British state itself. Taxes had to be paid in pounds. British merchants accepted pounds, and Britain remained one of the world's most productive economies. Those factors gave people confidence that the currency would retain value. Still, there was an important difference between the pound of that era and the modern dollar. British authorities insisted that convertibility would eventually be restored after the war, and once Napoleon was defeated, they followed through on that promise. Britain emerged from the conflict as the undisputed global superpower. Capital from around the world flowed into London. Investors stored wealth in British banks, securities, and financial institutions. Borrowing costs remained especially low. Unlike in the later Dutch experience, cheap capital initially fueled tremendous productive growth. Britain became both the leading industrial nation and the leading financial center. This combination was crucial. British factories produced goods that the world wanted to buy. As a result, gold naturally flowed into the Britain through trade. Confidence in British financial institutions remained extremely strong. Banks, corporations, and the government could extend credit across the globe. The pound became the preferred currency for international commerce, even in transactions where Britain itself was not directly involved. But history rarely stands still. The same abundance of cheap money that once fueled progress gradually encouraged complacency. Just as Dutch capital had financed Britain's rise, British capital now helped accelerate the industrial growth of the United States and Germany. At the same time, Britain's own industrial leadership began to weaken. New technologies such as electricity and assembly line production were transforming manufacturing, yet many established British industries were slow to adopt. Existing investments in older technologies create resistance to change. Meanwhile, competitors like Germany and the United States pursued industrial expansion with remarkable determination, and they were willing to use methods that Britain often considered unfair or unconventional. Unlike Britain, which embraced free trade early on, both the United States and Germany took a different route. They protected their industries behind high tariffs and trade barriers for decades. Only after their manufacturing sector became globally dominant did they begin competing aggressively on international markets. At the same time, Britain's privileged financial position encouraged policymakers to stretch their ambitions far beyond what was economically necessary. Vast resources were spent expanding and defending colonial possessions across the globe. While these territories increased Britain's political influence, many contributed little to its industrial strength. Even so, the power of the pound once again proved decisive when Britain faced a new rival, Germany. Much like Unlike during the Napoleonic era, Britain lacked the military strength to defeat its continental opponent alone. Instead, it relied heavily on its financial advantage. London financed allies, supported foreign governments, and helped sustain the war efforts of France and Russia. Meanwhile, Britain's navy cut Germany off from critical imports and trade routes. Ultimately, Germany's economy buckled under the pressure. Yet, victory came at a tremendous cost. Britain accumulated unprecedented levels of debt. Once again, authorities were forced to loosen the pound's connection to gold. This time, however, the situation was fundamentally different. Unlike after the defeat of Napoleon, a powerful alternative now existed. That alternative was the US dollar. Ironically, very few people had anticipated this shift. Before World War I, the United States was already an economic giant. Yet, despite its industrial strength, the dollar was not widely viewed as a genuine competitor to the pound. Everything changed in 1913. That year, the United States created the Federal Reserve System. At roughly the same time, restrictions on overseas operations by American banks were relaxed. These reforms transformed America's financial infrastructure. For this first time, businesses around the world had access to a credible alternative to London's financial system. As Britain emerged from the First World War burdened by enormous debts, investors increasingly questioned whether the pound remained as trustworthy as gold. British leaders faced a critical decision. Unlike the Dutch before them, they chose to fight for their currency's international status. Interest rates were pushed significantly higher. The policy helped stabilize confidence in the pound, but it came at a steep domestic cost. Economic growth remained weak throughout much of the 1920s. High borrowing costs weighed heavily on British industries and consumers. Nevertheless, the strategy brought Britain valuable time. In fact, the dollar briefly surpassed the pound during the 1920s. Yet, events soon took another unexpected turn. The Great Depression damaged confidence in the American economy. Investors once again sought safety in Britain. As a result, the pound temporarily regained much of its lost ground before World War II. This meant Britain entered another existential conflict while still returning part of its reserve currency advantage. The pound's influence throughout Britain's colonies and former colonies proved especially valuable. Countries across the empire continued holding reserves in sterling. During the war, this network effectively allowed Britain to borrow enormous sums from its own sphere of influence. But beneath the surface, the balance of power had already shifted. The United States no longer viewed the pound as an equal. In this early stage of World War II, Britain had to pay for American goods with gold. When its gold reserve ran low, other concessions followed. Military bases were transformed. Trade protections were dismantled. Economic influence increasingly moved across the Atlantic. By the end of the war, Britain had stretched its financial privileges to their limit. Debt levels were higher than ever. Meanwhile, the United States controlled the overwhelming majority of the world's gold reserves. As a result, Britain had little leverage when the post-war financial system was negotiated. As the Bretton Woods Conference, dozens of nations gathered to design a new global monetary order. The outcome was clear. The US dollar became the central pillar of the international system. It was the only major currency directly convertible into gold. Even so, Britain's decline was gradual than immediate. To the so-called Sterling era, London maintained significant influence for many years. Countries across Africa, the Middle East, South Asia, Australia and New Zealand continued holding substantial reserves in pounds. This lingering influence allowed Britain to preserve some of the benefits of reserve currency status. It also helped reduce the burden of wartime debt. By keeping interest rates below inflation for extended periods, Britain effectively effectively eroded part of its debt load over time. Yet, the broader trend remained difficult to ignore. Britain's relative economic position steadily weakened. Compared to the United States, it fell behind. Countries that had once lagged far behind Britain, including Germany and the Netherlands, gradually caught up and in some areas surpassed it. The pound also became increasingly vulnerable to financial turbulence. Major currency crises repeatedly shocks confidence in Britain's economy. Episodes in the 1970s and the early 1980s, the Brexit period and the turmoil of 2022 all demonstrated that Britain no longer possessed the same financial privileges it once enjoyed. So what does Britain's experience teach us about the future of the dollar? First, it shows that the key advantage of reserve currency status remain remarkably consistent across history. A dominant currency allows a nation to borrow more easily, it allows borrowing at lower cost, and perhaps most importantly, it often attracts capital during crises rather than losing it. These advantages can dramatically enhance geopolitical power. They allow governments to finance alliance, project military strength, and absorb shocks that might cripple other countries. However, Britain's story also reveals another pattern. The loss of reserve currency dominance rarely happens overnight. Instead, it is often preceded by years of volatility, financial stress, and gradual declines in influence. The Dutch experience was dramatic and sudden. Britain's was slower, but still transformative. The result was a prolonged period of relative economic stagnation that some argue continues to shape the country even today. One lesson stands above all others. The existence of credible alternative matters enormously. Britain managed to survive huge debts during the Napoleonic era because no serious competitor existed. Investors had nowhere else to go. As a result, Britain prospered despite burdens that might have destroyed another nation. But once the United States built a credible financial system, everything changed. Within a relatively short period, the dollar emerged as a genuine rival. Britain delayed the transition through painful sacrifices. Yet, history now shows that the pound's long-term decline had already begun. The obvious question is whether the same process is underway for the dollar today. The answer is not necessarily. Unlike the pound, the dollar has already faced a major crisis of confidence and recovered. In fact, it returned stronger than before. To understand why, we need to examine the next chapter in this story: the rise, decline, and resurgence of the US dollar itself. The modern dollar era effectively began in 1944. With the Bretton Woods system in place, America became the undisputed center of global finance. Initially, the pattern looked remarkably familiar. The United States dominated both industry and finance. Its factories supplied the world, gold flowed into America's vault. American banks and governments programs distributed dollars internationally through loans, investments, and reconstruction efforts. This influence allowed Washington to build the world's most powerful navy. It financed allies across multiple continents. It projected military and economic power on a scale never seen before. At the same time, many of the classic side effects of reserve currency status reappeared. Financial elites gained influence, capital flowed into the emerging competitors, protected foreign industries gradually developed into serious challengers. Government spending continued expanding. Eventually, pressure on America gold reserves became impossible to ignore. In 1971, convertibility into gold was suspended. To many observers, this looked like the beginning of the end. Similar events had preceded decline in previous monetary empires. Yet one crucial factor was missing. There was no superior alternative. Europe lacked political unity. Japan was too small. Other economies lacked the depth and stability required to replace the dollar. Instead of abandoning the dollar, America's allies adjusted around it. In many ways, the system recognized itself rather than collapsing. This is where modern history diverges sharply from previous examples. Nixon's suspicions of gold convertibility was originally represented as a temporary, but it ultimately became permanent. The dollar evolved into a fully fiat currency, and rather than collapsing, it became even more dominant. Why? Because the true foundation foundation of a currency is not a precious metal. It is economic and political system standing behind it. The dollar is backed by the ability of the US government to collect taxes. It is backed by American institutions, law, businesses, and consumers. People accept dollars because they know others will accept them too, and because they know those dollars can always be exchanged for goods, services, and investments within the world's largest financial market. This fundamentally changed how reserve currencies operate. Under older system, capital flowed towards the financial center. Under the modern system, America effectively supplies dollars to the world through spending and investment. As a result, many countries now accumulate dollars and reinvest them back into the US assets. But it is coming to the end, maybe. Paradoxically, large trade deficit, which would once have threatened reserve currency status, can actually reinforce dollar dominance. Economists argued that this dynamic is one reason the dollar remains so powerful today. Looking ahead, two major conclusions emerge. First, replacing the dollar may be far more difficult than replacing previous reserve currency. China possesses the industrial scale necessary to challenge America, and policy reforms could make Chinese financial markets significantly more attractive. Yet, economic size alone may not be enough. Many countries have built export-driven growth models around access to American consumers. The dollar's dominance is closely tied to that role. Second, reserve currency privilege is not indestructible. It still depends on trust. Foreign governments, investors, and institutions must remain willing to hold American assets. For decades, strong institutions, predictable rules, and relatively low inflation supported that trust. But recent events have raised new questions. The freezing of foreign reserves, growing geopolitical tensions, trade disputes with allies, discussions about using financial leverage in increasingly aggressive ways. Together, these developments have caused some investors to reconsider long-held assumptions. Signs of increased volatility have already appeared. If confidence continues eroding, the United States could gradually lose some of the advantages that reserve currency status provides. Financing global military commitments would become more difficult. Foreign investments could slow. American financial markets could face sustainable pressure. Importantly, history suggests that losing reserve currency status does not automatically eliminate the structural problems that developed during the period of dominance. The benefits may disappear faster than the burdens, yet history also offers a more optimistic possibility. Reserve currency have recovered before. The dollar itself has already survived one major crisis of confidence, and compared with many rivals, the United States still possesses significant strength. Whether the dollar declines, stabilizes, or becomes even stronger will depend largely on future policy decisions. Ultimately, the next chapter of this story has not yet been written.